You can log into any brokerage account today and immediately access millions of live data points. Every tick of the market, every quarterly earning, and every technical indicator is right at your fingertips. But while this information is accessible, the sheer volume of it makes it easy to lose sight of actual value. To survive the noise, many investors search for a mathematical formula, a quick filter on a stock screener that promises to spit out guaranteed wealth. When the formulas feel too complicated, the next logical step is to bypass the hard analysis entirely. You find a celebrity super investor and simply copy their trades. After all, they are billionaires. If they are buying a specific stock, the assumption is that they must know something you don't. There is a glaring logical flaw here. You can spend all day plugging variables into a screener to find the perfect stock. But if wealth could be generated simply by applying a generic mathematical formula, automated machines would already own the entire market. Instead of rigorous analysis, retail investing has mutated into a casino, largely driven by social media. Algorithm-fed platforms like WhatsApp or Telegram are incredibly efficient at feeding you an urgent buy signal today. What they will never do is follow up with you 6 months later to tell you it's time to exit. Finding a stock that looks good in an isolated vacuum is incredibly dangerous. The numbers you see on a screen often hide severe structural traps. To build a portfolio that lasts, we have to expose the flaws lurking inside these easy data shortcuts. Let's start with a common trap for bargain hunters, the 52-week low list. Whenever the market takes a hit or runs flat, investors pull up this list, assuming they are looking at a menu of heavily discounted companies. A low price tag is not proof of a market bottom. Stocks do not have floors. They can always fall closer to zero. Often, what looks like a rare bargain is actually a value trap, a low-quality business in terminal decline, where the price is dropping because the underlying company is failing. This brings us to the strategy of tracking and replicating the public portfolios of billionaire investors. It seems like a foolproof way to ride the coattails of Wall Street's elite. This diagram illustrates a critical regulatory loophole. Billionaires are only required by law to publicly disclose their holdings when they own more than 1% of a specific company. If a super investor takes a tiny sliver of their massive net worth and drops it into a small microcap company, it easily crosses that 1% threshold. Suddenly, their name becomes public, and the investment is reported as a major endorsement. But look at what happens when they invest in stability. If that same billionaire pours billions into a massive blue-chip company, the sheer size of that company means their investment fails to trigger the 1% disclosure mark. Their safest positions stay completely hidden. This creates a massive mismatch. You look at public disclosures and assume the billionaire is aggressively targeting small companies. You might end up risking 20% of your life savings on a volatile microcap that was literal pocket change for the celebrity investor. By copying these famous public portfolios, you inadvertently force yourself into high-risk trades. The data available to you is naturally skewed towards small caps, which can trick you into treating speculative bets as a core strategy, which leads us back to stock screeners. While they feel objective, these purely quantitative tools have a massive blind spot. They cannot read qualitative, real-world context. Algorithms are easily manipulated by one-time events. Imagine a struggling company that sells off a piece of commercial property. For that single quarter, a huge influx of cash hits their balance sheet, simply categorized as other income. This chart shows how steady company earnings can suddenly spike due to that property sale. Because the earnings number temporarily shoots up, it forces the corresponding price-to-earnings ratio line graph to artificially plunge straight into a green buy zone. The mathematical formula signals that the stock is cheap, entirely missing the fact that the company just sold its assets to generate that cash. The inverse is also true. Perfectly healthy seasonal or cyclical businesses, like companies selling winter gear, will look fundamentally weak on a screener during their off-season. The math punishes them simply for the month of the year. Screeners are highly susceptible to these temporary disruptions in the market that distort the true financial picture. They are useful for casting a wide net and generating a list of ideas to explore, but they should never act as a definitive signal to execute a trade. To actually validate an idea, we have to stop analyzing stocks in isolation. Professional investors rely on a side-by-side peer comparison framework to understand a company's true performance. This comparison matrix shows how the process works. You take a company you're interested in and line it up directly against its industry competitors. You measure their sales growth, their debt loads, and return ratios like ROE side by side. When you force similar business models to compete on paper, the vast majority of mediocre companies fall away. By setting strict benchmarks for profitability and debt against a sector average, you quickly narrow the market down to the few companies that actually command their industry. Once you have those survivors, you apply a reality check: consumer experience. Retail investors often buy obscure mining or gold refining stocks where they have zero daily interaction with the business. Instead, look at the products you use every day, the soap in your shower or the medicine in your cabinet. This provides a layer of insight that spreadsheets cannot: first-hand experience of product quality and brand loyalty. It anchors the abstract data you pulled from your peer comparison in your own experience as a consumer. Successful investing requires moving away from random, algorithm-driven suggestions toward a repeatable filtration process. The reality is, executing rigorous peer comparisons takes time. If you lack the hours to deeply analyze debt loads and return ratios, the most financially sensible move is to stick to mutual funds. If you prefer professional assistance for individual stocks, seek out SEBI-regulated experts. Relying on deep research from professionals is a strategy. Relying on unregulated social media advice is a gamble. Finally, remember that stock market gains are only one part of financial security. If an unexpected event causes a severe income shock to your family, your portfolio may be drained to cover basic needs. Securing a term plan through advisors like Ditto ensures your family's expenses are covered, protecting your investments from being liquidated in an emergency. Sustainable wealth isn't found in a shortcut. It requires looking past the surface of easy formulas, verifying data through peer comparison, and anchoring your decisions in the reality of the market.